Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Mitch Firestein, author of Planet Ponzi. Hey, you there in the airport. Yeah, you're going to miss your flight, but pick up a copy of this book. It's being printed in many languages now. It's a fantastic... Welcome to the Keiser Report, Mitch.
Thanks for having me here today.
Now, I should tell folks that you're on the front line of all this. You're a hedge fund manager, so you're got all the screens every single day. You're checking all this, and you're gasped by what's going on at the same time. So you're hedge fund in the bunker of what's going on. Now, I want to ask you some specifics. The Financial Stability Board recently announced that they had discovered $6 trillion more in the shadow banking system than they had previously understood to be there. What should we know about the $67 trillion shadow? How it relates to Planet Ponzi?
I think one of the big issues that you need to discuss is the lack of transparency and accountability throughout the political system and throughout the government in terms of governance being lacking. I mean, the Fed, for example, gave it was estimated $13.9 trillion in secret loans to financial institutions and different institutions during the height of the crisis.
That came out from Bloomberg's Freedom of Information Act request, didn't it?
That's correct, and I think it should have been transparent and upfront, and we should be able to see what the Fed has on their balance sheet. I know the Fed is coming out and saying one thing, but they're doing another thing, which is a little bit dangerous when you have massive amounts of money flying around. There was an interview with a congressman asking the chief inspector of the Fed, what about this $9 trillion, where has this money gone? And the inspector said, we're investigating this on a high level, but we don't know who that money was lent to right now, and we'll get back to you.
Got a few points here. Let's roll back for a second, because, okay, I understand that you need more transparency. The Fed is being disingenuous. They're doing things under the shadow banking system. But the size of the shadow banking system itself, though, is so huge that it's bigger than the global GDP. And so that's like having a parallel planet orbiting Earth, a Death Star, almost. It's not to get too dramatic here, but it's an enormous chunk of change floating out there. It's unregulated. It's right now tied to interest rates that are near zero. But if interest rates just tick up 50 basis points, you're talking about how would that affect the global economy and the bond markets? Wouldn't that have kind of a ripple effect?
You're exactly right, and that's the point that I'm trying to make, that people need to wake up and smell the coffee, because their $67 trillion number, global GDP is only about $68.9 trillion. That's goods and services produced by everybody on the planet if nothing's spent. So, the problem that's created are people aren't looking at what the derivative exposures are, because going back to my example with the Fed, none of these derivative products existed back in the day. So, I mean, they haven't come up with a way to manage all this risk effectively. Bond yields, you're right to point out, are ridiculously low, and they've been manipulated by the central banking institutions around the world printing money and buying their own bonds. But that, in effect, is a Ponzi scheme, and it won't last. Because if you think about it, in 2011, the United States paid $55 billion in interest on their debt, interest rates being at a 200-year low. So what does that mean? You're right. If it goes up 50 basis points or 100 basis points, it's catastrophic. And I don't know anybody who would buy longer end at the current yields that they're trading at, because it just doesn't make any sense.
In the UK, they're trading at a 300-year high.
That's correct.
And that's a bubble, isn't it?
Absolutely.
Okay, but let me ask you something. You're on the front line. You're a hedge fund manager. Your job, obviously, is to preserve wealth, make wealth. And even though you know the risks involved here, you have a fiduciary responsibility to your clients, you still have to buy into this quantitative easing by either front-running the Fed or the central banks, or pretending that you don't see the dangers because everyone else in your business does the same thing. So to maintain your performance relative to your peer group, you can't be the one guy to stand up and say, I don't believe it, because if everyone else believes it, then the perception is reality.
I agree with the point that you're making, that you can jump on board the train. I always like to be a rider on the train rather than a smashed bug on the windshield. So you're not going to stand in front of a trend like that. So you've got to recognize the trend, and hopefully you're going to get out in front of a trend, see a trend, and follow the trend. But you've got to know when to be nimble and get in and out. And I think, like the equities markets, with all this quantitative easing, what's happened is you've got unintended consequences. So you've got asset bubbles that have been blown up. London real estate, a prime example. The equities market's a prime example. You've got people, what you've had for the past 12 to 13 years is global GDP increasing at between 3 and 4%, and you've had debt increasing between 11 and 14%. So basically the world has been living off of debt. You can't spend 3 times more than you make. It's just not a sustainable formula.
Now there's some nomenclature involved here that seems to be misused. Inflation, deflation. 2 words that are remarkably misused, because you just described a situation of low interest rates jacking up asset prices in a way that people feel when they go and buy gas, or they see it when they're buying food, and they would normally equate that to being inflation. However, the central banks are saying they're fighting deflation. So either those words are meaningless, or the theory behind them is corrupt, or we're living in an upside-down world where there is no base scenario that makes any sense at all.
I think that it's an interesting concept, inflation and deflation, and when you come up with terms and you change your definitions and you use a basket that makes it look like there's no inflation because you exclude food and energy, it's not really telling the truth to the public, because when people go out and they purchase items, you'll see that beef prices in 5 years are up 90%.
Yeah, but Mitch, when the central banks, when they lower interest rates saying they're fighting deflation, are they not, in fact, creating deflation?
I would argue that they are.
Okay, see, I want to make this point, because this is a very interesting point that we're making here, is that they're creating the very thing that they say that they're fighting. Explain how.
Well, here's what happened in Japan. If we use Japan as a model, back in the 1990s, late 80s and 90s, the Nikkei stock market went up to as high as 40,000, and real estate prices were $20,000 per square foot in central Tokyo. Now, those were 2 bubbles that were created by the marketplace that we see happening now in other places around the world. And so what happened in Japan? When the bubbles popped, the asset bubbles popped, they got into a deflationary scenario, and they were the original ones with QE. Now, that's the same thing that's happening right now around the world. All the other banks are printing money. So now what it is, it's a race to debase currencies. Now, currencies, if you look at Japanese JGBs, the bonds, the main holders, their debt is over 200% of GDP in Japan. But the main holders are the pension funds. And the pension funds are the people, their pensions are evaporating, and they'll probably never be paid the money that they expect to retire. Okay, but the currency has appreciated drastically against the U.S. dollar. It's gone from way over 3 digits, like 110 or 115, down to 77 yen per dollar. So people have made money on that, and the trade actually worked. But now you're getting an unwinding, and you've got a new prime minister who's got a real big job on his hands there, who's just walked into a job. It's his 2nd time around. Hopefully he'll be able to make some significant changes, but the changes he wants to make are the Keynesian changes, where the Keynesian model is just to print more money. Now, that works in surpluses, and I think that this is where we get to the point you wanted me to make, is in a surplus environment that works fine, but when you have large deficits, it doesn't help. You can't spend your way out of debt with borrowed money.
Okay, Japan, interesting, because, of course, for many years, post-World War II, they were an export powerhouse. Their balance of trade was in their favor. That has now recently reversed, so they're now net importers. So they don't have that cash to rely on to float their bond market. And they've had, of course, their domestic savings, pool of savings to finance their bond market, but now there's a limit to how much their savings rate has actually been declining from the famous years when it was higher. It's now down to almost, first world levels like the United States. So given the global game of chicken that's going on and currency debasement that's going on, you look at this as a big poker game. Who's holding what hand? It seems like Japan is really, we talk a lot about the U.S. and the Eurozone, but it seems like Japan is holding the weakest hand of any of the G7 countries in terms of heading into the bond okay corral.
Yeah, I think the bond market, you can't get in front of it because it hasn't started to decline yet. But I think when they start printing money in Japan, it's going to be a big problem.
And the new leader has said that's his mandate.
Right, absolutely. But so you'll see the currency decline. You'll probably see it go over 100 again versus the U.S. dollar. And that would be an indication that you wouldn't want to be involved in Japanese bonds or JGBs because, you can lose on the currency on that trade. So, I think you also have to look at what the other central banks around the world are doing. It won't be long before the ECB starts printing money. Mark my 2013, Draghi the Super Mario Brothers will be back, and probably a lot of money printing in the cards.
Well, part of the fiscal union in the Eurozone would require a massive money printing to make all those things work out and mesh together. Now, another trade that's been a long time coming that hasn't yet kicked in yet would be the London real estate trade. Now, in 2013, you're predicting that we're going to see a big fall in London property prices. Again, being in the wrong side of this trade for a number of years has been wrong, but you say now is the time to go short possibly London real estate.
Well, unfortunately, there's no avenue that you can short London real estate, but I would advise not being involved in London real estate. I think there's going to be problems with the currency, so you can lose several ways on the trade. If sterling goes down against everything else, then your investment value is going to go down to the property that you purchase. There's a fundamental disconnect here between income levels and property prices, which go back to the beginning of history, you'll see that there's always been a correlation between income and property values. In the last 12 years, there's a disconnect in London, and prices have gone up over 500%. Now, if I slept through an industrial revolution or something, I don't know, but I think the banks have been lending irresponsibly again. And if they were to have to mark to market a lot of the loans, it would be problematic for them. Commercial real estate's going to have its woes as well. I mean, look at the Shard.
Yeah.
Nice project, but I think it's empty. I don't think they have any commercial tenants in it.
Is the Shard been back of us somewhere?
It's over here.
You can see it, but I don't know if you can get a shot back there. There's a full panoramic view of a
There are
collapsing...
no lights on because nobody's there, but
right.
It's great.
But it's all that money printing now that goes by central banks. Goes to folks that are gaming the system, for want of a better term, and then they need to park their profit somewhere, and they end up parking it in London real estate. So it's a beneficiary of central bank largesse.
Well, I think that you have the same advisors all the time, which is part of the problem. I think the governments need to step out and get ahead of the curve and bring different people in. I think we've had the discussion before that Larry Summers keeps coming back and advising, and he was the one that created the beginning of the end with the repeal of Glass-Steagall in America.
He's part of the zombie apocalypse.
Right, exactly. And Gordon Brown forgot that he was the one that sold all of the UK's gold at 377
400 tons, 60%.
Exactly. But what's that? Everybody's forgotten about what Gordon Brown did, and
Not the Queen. She was down in the vaults.
That's
she was
right.
looking around like, didn't we have more gold at some point? What happened to all this gold? Mitch, we're out of time.
Okay.
I have to say goodbye.
Great.
We have to have you on again soon. The book is right here. This is it. I got to recommend this book wholeheartedly. I'm going to read it myself soon. It's called Planet Ponzi. Mitch Firestein is the author. Thanks so much for being on the Keiser Report.
Thanks for having me.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Mitch Firestein. If you'd like to send me an email, please do so at KeiserReport@rttv.ru. Until next time, Max Keiser saying bye, y'all.